M&A. So why M&A? Why would you engage in this merger or acquisition? Well, a simple reason is that you have an undervalued target. So we talked about this idea quite a bit when we discussed the agency problem in corporate governance. We said there's a whole market for corporate control. And the idea is that if you're an undervalued target because you're being mismanaged, your share price is low. So we have an acquirer make an efficient response to the target being poorly managed. We also have synergies in the idea 1 + 1 = 3. The value of the combined firm is greater than the standalone valuations of the individual companies, the acquirer and the target. That's how we think of synergies. And the intuition behind both the undervalued target and the synergies, we have corporate governance. So maybe the firm is being poorly managed. That's the reason why the target has a low price, or maybe the acquirer is exceptionally managed in redeploying the target's assets and human capital to the acquirer would have even better returns. There's also financial constraints. And we talked about this a little bit earlier, but the main idea is that the acquirer might be well capitalized, meaning you got a ton of cash, but you don't have a lot of investment opportunities. Or you don't really have a ton of debt, but you can observe a firm that does have a lot of debt. And as a consequence of that debt, the firm is underperforming because of all the stuff we talked about with the cost of bankruptcy. And you also have agency concerns. So if the firm is poorly managed because the CEO is essentially setting up a little fiefdom instead of doing their work, then yeah, in theory, that share price should be low and the acquirer will come and identify the target as undervalued and buy. All of these relate to different frictions that we've talked about with agency concerns, with the market for corporate control, and everything else. What's important is that the synergies are not guaranteed. It's not guaranteed that just because you target a firm and announce that you want to acquire them, that the market will perceive your ability to redeploy the firm's assets and human capital as a really good choice. So the synergies are by no means guaranteed. There are other reasons for cross-border M&A. One, at least relative to greenfield investments, is these are faster. So these can be much faster. It can take years to build a new facility. It could take a year or two to acquire and buy a new firm. And even by M&A standards, you've got tons of negotiations that happen well before the deal is announced. The other reason why you might acquire a firm is because you really want access to its proprietary assets, meaning the firm has something that you really, really want to get your hands on. So just like we talked about with intangible assets and intellectual property and corporate strategy, same rules apply here. I may want to acquire the firm for the same reasons that I would, that I'd want to acquire any firm that's really well done. It just happens to be in another country. Okay, other reasons for cross-border M&A, managerial entrenchment. What does that mean? Managerial entrenchment means that the acquirer, the firm that's doing the buying, might be poorly managed. So the intuition is empire building. If you remember when we talked about agency, we said that one of the ways that a manager can make themselves really, really difficult to fire or difficult to be let go of is by having a bunch of projects that only they can tend to. So that's sort of empire building. Sometimes we'll talk about firms being serial acquirers because they are looking to grow. So oftentimes you'll hear within financial press this discussion of how do we grow? We can grow organically, meaning that you take advantage of investment opportunities and you grow the firm, or you can grow through acquisition. So you can buy another firm's investment opportunities and cash flows and then use that as a way to grow the firm. The last argument behind cross-border M&A is also a behavioral argument. And that idea is that you could just have an overvalued acquirer. So if I'm the manager of a firm and I know that the firm is misvalued, I know that my firm has a higher market valuation than it should. And if you remember from these corporate governance examples, we said that there were cases where I might know something because I'm privy to all of this information that the public doesn't. So there can be a discrepancy between those prices. If you have an overvalued firm, one of the things you may consider doing is using stock to go acquire another firm. So hopefully that makes sense. The idea is that if the stock is overpriced, I can go use it to basically arbitrage this market. So why M&A? Undervalued targets and synergies. We also have other reasons. It's faster. You can have proprietary assets, proprietary information. And then we said there might be bad reasons too. It could be because of managerial entrenchment. So maybe the acquirer is poorly managed. And it could also be just because the acquirer has an overvalued asset that they would like to essentially arbitrage. This is a table of the average wealth gains from foreign acquisitions of US firms. So hopefully you can see sort of the internalization theory put to test in real life. You have R&D relative to sales, so R&D intensity. And you can see they're fairly comparable between the acquirers and the targets. The targets generally have higher levels of R&D, but not always, but for the most part, comparable to, in most cases, higher levels of R&D relative to sales. You can also see changes in wealth. So these are the wealth gains from the acquisition. And again, these are foreign firms acquiring US targets. What do you see? You can see that for many of the acquirers, there are actual losses in wealth. They're negative, they're reductions in wealth from these acquisitions. So how should we expect the market to react to an M&A announcement? If the targets are undervalued, then the target share price should go up. And hopefully that makes intuitive sense. If you've identified a firm that is poorly managed, once you announce that you want to acquire that firm, the share price will usually go up. What might the acquiring firm, why might these acquiring firms in the table have experienced losses in wealth or negative gains on average from acquiring these US firms? If you remember, we just said that there are quite a few not good reasons why you can also acquire a firm, like empire building, like having an overvalued asset. So yeah, it could be managerial entrenchment, it could be a negative signal to the market, there could be lots of different reasons. Okay, and last thing I'll mention is that the market does not always believe in the synergies that you're arguing to justify your merger. Okay, FDI involves these pretty long-term investments. So you're building a new plant, you're buying a new firm. These are very long-term investments. Recall from our NPV equation that if we found that the NPV of a 30-year project was greater than 0, we would invest in that project. So we've got the NPV today at time 0. We've got our cash flow at time 0. We've got our expected cash flows. We discount them all the way back. All right. 30 years is a long time, and a lot can change during that time. What would happen if your project became somewhat of a failure in year 5? Well, obviously, you wouldn't want to be stuck for the next 25 years with a failing project. It could be worthwhile to just abandon the project entirely. The NPV on the previous slide does not account for that updating. What we had in our numerator was an expected cash flow. What we had in our denominator was a discount rate. Nowhere in there did you see any way to account for the fact that if things go south or if things take a turn, we'll just want to drop off the project altogether. So if the project did end up being a bust after 5 years, the flexibility to abandon the project could prove highly valuable. That is, the real option to abandon the project could be highly valuable if it involves avoiding future losses. What would we be willing to pay for the real option today? More generally, real options, in other words, we're really saying that managerial flexibility is valuable. It's valuable to be able to delay a project. Maybe I want to wait and learn some information. Maybe I want to hold off until some uncertainty resolves. It's valuable to be able to abandon the project. If this is going terribly and I'm stuck here for the next 20 years, I would love to be able to cut ties on this project and dump it. And then lastly, the ability to expand. If things are going wonderful and I'm here for the next 20 years, well, maybe I'd actually like to ramp up production. Maybe I'd like to increase production. Having flexibility is almost always preferred to having no flexibility. So what we're going to do is quantify this flexibility, meaning the ability to adapt to this new information. We're going to try to see how can we quantify, put a number to the value of being able to wait to get this new information or being able to abandon a project because things are going poorly. Examples of real options: delaying construction of a housing development for 1 year in hopes that market conditions will look better next year. Well, yeah, you're waiting to get more information. A great example of real options that happens all the time are within the product market. So all the time, companies will test a new product or test a new line with the option to expand it if the market results are positive. You see the same thing with strategic choices. So Microsoft introduces the search engine Bing to compete with Google, but has the option to abandon the project if things do not go well. More generally, a negative NPV project is sometimes justified as a strategic investment if it offers the ability of the firm to basically dabble into a market or get access to a market. So you'll hear within financial press, CEOs, CFOs, managers describing strategic investments or strategic acquisitions. You see this all the time with tech. You'll hear of Google or Facebook acquiring a startup or acquiring or making a strategic investment into a market that they may have no products in, but what they really would like is the opportunity to expand should something go well, or the opportunity to abandon a project should things go poorly. More generally, greenfield investments overseas, the ability to invest in an unprofitable venture in a new market. All of these are examples of real options. Let's do an example together. You can invest in a project either now or next year. If it is successful, you get an expected cash flow of 40 million the following year. If it is unsuccessful, you get an expected cash flow of 8 million the following year. The project costs 15 million and has a discount rate of 12%. The chance of success is 50%. Okay, so what do we see? We can observe that if things go well, it's a 50-50 toss-up, expected cash flows of 8M, okay, very straightforward. If it's successful, okay. What is the NPV of the project if you invest today? Same way you would set this up normally. If you wait a year, you'll know whether the project will be successful or not. The chance of success is still 50%. What is the NPV of the project today if you decide to wait for a year? So as you set this up and work through it, there are two things to remember. First, hopefully you can see that 8 million, the expected cash flow, is less than 15 million. So very clearly, there are going to be states of the world that if we can wait and learn whether or not the project is successful, we're going to avoid producing it. What is the value of the option to wait? So after we calculate the NPV across these states of the world, we'll observe that there are states of the world that we do not want to operate in. And the beauty of being able to wait to get this information is we can essentially avoid these negative states of the world. So this is an example of a real option to delay a project. Hopefully, as you work through this and as you set it up, what you'll see is that the NPV of the project without delay was much lower than the NPV of the project with delay. That by waiting to get more information, we can basically avoid operating if we're operating at a loss. We're going to avoid these states of the world where we don't want to invest. Example 2, your company is deciding whether to expand production in the UK. The expansion will generate cash flows for the next 10 years, starting next year, and cost 65 M when expansion begins. Assume a discount rate of 10% per year. There's a 50% chance the facility will generate high or low cash flows. There's a 30% chance that the UK will have a strong economy and a 70% chance the economy will be weak. So we've got a table of our different states of the world and what the value of the cash flows are in these states of the world. If we're in a high cash flow state with a good economy, it's 20 million per year. A high cash flow state with a bad economy, it's 15 million per year. Notice how the low cash flows are all lower than the high cash flows. If we're in a low cash flow state with a good economy, it's 10 million per year. If we're in a low cash flow state with a bad economy, it's 5 million per year. So what are your questions? What is the NPV of the project if you invest today? This would be the standard way that we set up all of our NPV problems. Next, I want you to calculate the NPV of the project today if the economy is good. So if we are in a good economy, what's the NPV of the project? If we're in a bad economy, what's the NPV of the project? If you wait a year, you'll know whether the project will have high cash flow or low cash flow, but you'll still be uncertain about the economy upon the expansion of the facility. What is the NPV at T1 if cash flows are high or low? What is the NPV today of the project if you decide to wait for a year? So as you set this up, hopefully what you'll see is that, again, there are going to be states of the world that you don't want to invest in. And what's wonderful is that because you've waited to identify those states of the world, you can take that into account. And obviously the value of the option to wait, it's going to be the NPV with waiting versus the NPV without. So the option to delay, notice that there are states of the world with no investment. For example, we would not invest if the economy is bad. So when you do the math and you calculate it out, what you'll find is that when the economy is bad, the project would have a negative NPV. The expected cash flow from the project, the 61.45 M, is less than the cost of the project, so you would have a negative NPV. Our research does not resolve uncertainty around a good or bad economy. It does resolve uncertainty around high cash flow or low cash flow. So let's take a look. Notice that we exercise our option to invest when the expected present value at T1 of the future cash flow is 101.39 M. How did we get there? Well, when we wait, what we observe is that if we end up in a state with, when we wait, if we end up in a state with high cash flow, the expected cash flows are higher than the cost of the project, the 65M. We do not exercise our option to invest when the expected present value at T1 of our cash flow is 39.94 M, which is considerably less than the cost of 65M. That is, the option to delay the investment, to expand the investment, really resembles a call option. The present value of the future cash flows is greater than the cost, we exercise the option. If we have a positive NPV, then we go for it. If the present value of the future cash flows is less than the cost, we do not exercise the option to invest the T1. Yeah, if it's a negative NPV project, we let it go. If there were a hypothetical case with the implied expected future cash flows at T1 equals 65M, we would break even if we made the investment. What does this look like? Okay, this looks super similar to a call option. On our vertical axis, we've got our payoff, essentially our NPV, because it's our expected cash flows, our discounted, the present value of our expected cash flows less our investment cost. That's NPV. So on our vertical, we have our NPV, and on our horizontal, we've got the present value of our expected cash flows. And hopefully what you observe is 65 is just like the strike point for a call option. It's just like K equal to 65. That is, we take the project at T1 if the NPV is greater than 0, but we do not take it if the NPV is less than 0. And hopefully what you've observed as you work through these problems is that we always have to account for the fact that we're delaying the investment if we wait. So we do want to discount the change in NPV because we're still waiting. So that's why everything here is at T1. Okay, the option to abandon. Abandonment is another type of real option. A firm may be able to mitigate its losses by abandoning a project, by basically cutting ties. That is, the firm has the option of simply walking away. Abandoning a project can potentially create value for a firm as you stop a money-losing project. Example 3, you decide to open a mobile phone facility in Jamaica. The factory will produce cash flows for 13 years, starting in 2 years. Each will sell for $300, and the variable cost is $270 per phone. The fixed cost of operating the factory every year is 1M. That fixed cost also starts in 2 years. You're uncertain about the demand for phones. Yearly demand can take on one of 3 values. It can be low, in which case you sell 25,000 phones, medium, where you sell 50,000 phones, or high, where you sell 100,000 phones. The probability of the low, medium, and high states are 25%, 50%, and 25% respectively. You learn what yearly demand will be in year 1. This demand will remain fixed for the life of the project. A, what is the net present value of the expected cash flow from your operations? Assume a discount rate of 11%. As you set this up, you have $300 per phone. It costs $270. 300 minus my 270. I know how much I make per phone. I don't know how much that is relative to the demand. So let's do that math. We've got our 100K, our 50K, and I think 25K. So we multiply those by the $30 that we make per phone. And now we've got our cash flow that we would expect every single year. We're then going to subtract our 1 million, because our 1 million is our fixed cost that we're going to incur for the operating facility. And now what that is going to tell me is every single year how much cash is going to be flowing from these firm operations. So I can take that, throw it into my annuity formula, and then I've got the present value across these states of the world. Then multiply it by my probabilities, and I've got my NPV of the expected cash flows. Suppose you have the option in year one, after learning what yearly demand will be, to abandon the operations and sell the factory for 5M. What is the net present value of your operations with this abandonment option? There are two things I just want to make sure that we are careful with. One is that because there's a 2-year delay, you want to make sure that you discount. And two, when we think about the abandonment option, the way to think about this is any state of the world where my cash flows are less than 5 million, I'm just going to sell this factory. I'm going to sell the operations for 5 million. So you can really think of this as protecting you against these states of the world where your cash flows are going to be less than 5 million. Next, create a payoff for the abandonment option. We're going to take a look at that next. What type of financial option does this abandonment option represent? And if you abandon this project in year one, you incur litigation costs of 2 million. Is the abandonment option still valuable? So let's look at that. The abandonment option, so when we do the math, again, these are all for the present value of expected cash flows in year one. So these are all year one numbers. What do you see? This looks super similar to a put. This looks just like a put option. I've got, again, on my vertical, the option payoff, the NPV, and on my horizontal, I've got the present value of the cash flows for these different states. And hopefully what you can see as you look at this payoff graph, notice that in the worst state of the world, where the demand is fairly low for the mobile phones we produce, if we were to operate in that state of the world, the present value of our cash flows would be negative 1.69 M. That option payoff of 5.69 M, that's because I basically have a put option. So I've got 5M minus 1.69 M. So that's how I get this really high positive payoff. More generally, you can think of this abandonment option as really, really replicating what it is that you get from a put. So the real world. In the real world, real investment fell tremendously during the global financial crisis. Investors faced a lot of uncertainty about the future direction of the economy. Why make an investment now when you have the real option to delay that investment for another year? And 1 year, perhaps some of this uncertainty would be resolved and the investment would look favorable once again, or maybe 2 years or 3 years. Similarly, would we expect to see firms delaying investment in response to the global pandemic? It's a good question. Okay, the big picture. Hopefully, you're very comfortable with FDI giving you a controlling stake of a business or a facility. You should be very comfortable with greenfield investments, with mergers and acquisitions. Again, you're looking for a controlling stake in the firm. We went through a number of opportunities and frictions to foreign direct investment. So trade barriers, we said there are ways that firms basically try to circumvent trade barriers. There are ways to deal with labor market imperfections, the fact that the labor market is not globally integrated. Intangible assets, because we have variation all around the world in the enforcement of property rights and in the protection of our IP, our intellectual property, our trade secrets, our corporate strategies, etc. And then lastly, political risk. Political risk is not restricted to only emerging or developing markets. Political risk is something that's become much more prevalent in recent years as we have a lot of political uncertainty. And remember, we said it can basically take on three forms. We've got our transfer risk, our operational risk, and our control risk. Cross-border M&A, significant portions of FDI, foreign direct investment, come from M&A. We said there are different motivations for M&A. There's synergies. Maybe your company plus my company better than either one of our companies alone. There's the market for corporate control. I don't like the way you're running your company. Because of that, the stock price is too low. I'm going to come buy your company. There's empire building. I really could care less about how your company is managed. I'm just buying a bunch of companies because it's a way to keep me employed. It's going to be super hard to fire me if I've got this massive sprawling empire, corporate empire that nobody understands. And then lastly, we said there are also behavioral motivations. If I'm an acquiring firm and our stock is overvalued, a really easy way of taking advantage of that is by going and buying another company and basically using my stock to go get my hands on some assets or on some cash flow that are properly valued. Lastly, net present value may underestimate the true value of the project when real options exist. The option to expand, abandon, delay, etc. The key idea is we want the ability to adapt to new information. And when we think about these foreign direct investment opportunities, because they are so long-lived, as a manager, you really want to be able to adapt to new information. Strategic considerations of a firm are usually corporate speak for real options. Okay, so our next lesson will examine the international cost of capital. Where we're headed is to look more into these investment decisions. So we'll look at the international CAPM, home bias, and then we'll get into even more portfolio decisions, the factor models, fixed income, and pricing FX. But you've learned quite a lot, and hopefully FDI makes sense. Thank you.